Hello everyone, this is Shifa Mehra from Dead Circle. Today I had a chance to speak about the expectations from RBI MPC with industry experts like Mr. Sajid Kumar from LabFit and Mr. Madhavan Kutti sir from Canara Bank. I also spoke with Mr. Pratap Singh Nathani, the CMD of Beacon Trustship. These are the insights that I had the opportunity to collect. It's the video.
This time around, when MPC looks at progress since last review in April, it will be much more comfortable given the way macros have panned out. Inflation readings have come softer than what it had anticipated. Growth has been resilient compared to what it had anticipated. And more importantly, the external sector, that has been more of a calming influence, right? Your currency is seen largely stable. All three together gives us a space to continue the monetary accommodation that RBI has already undertaken, right? Now, when it will be looking for setting the next course of policy, it has to look at the medium-term drivers of growth. Now, Q4 reading notwithstanding, consumption still remains average. I would not say very bad, but average compared to the long-term trends we had seen. We need to also see whether investment sustains. Specifically, the last quarter was mostly public sector driven, so that has to shift to private sector led investment momentum. And net exports, though it was favorable in Q4, we have to watch for what is unfolding in terms of Trump tariffs and its effects on India's exports. All these point to a situation where monetary policy will have to work in tandem with fiscal policy in supporting India's domestic growth, right? On inflation, since the monsoon outlook is also positive, commodities are seen softer because of the global growth is seen weaker, and the core inflation, which has been closer to 4% for a very long stretch of time, is seen largely anchored. The full year outlook on inflation is likely to be around target levels. I don't see an urgency on part of RBI to revise its outlook, either on growth or inflation. However, they will use this window of opportunity to affect further easing of policy rates. I expect a 25 basis point cut in repo rate, with terminal rates in this cycle coming around 5.5 to 5.25%. So this is my primary expectation. On developmental part, RBI may also like to look at levers to promote credit growth, specifically credit to industry. So microprudential measures may be also announced to ease constraints to credit, specifically to MSMEs, to industry. That should be in a way building on the good work that is already done both on the monetary side and the fiscal side to support India's growth economy.
So tomorrow's MPC, I'm expecting a rate cut of 0.25%. A couple of reasons that I think will make this applicable to tomorrow's MPC. One is inflation has been down substantially from the RBI's perspective, who's been wanting to control inflation and bring it down. So it's come down to about 3.16%, down from 4% that it usually was. Secondly, economic growth per se has been high at about 7.4%. For the year, we are expecting a 6.5 average rate of growth. Third is liquidity measures. RBI has pumped in $100 billion into the banking system over the last 1 year. So liquidity perspective, the RBI has injected a lot of liquidity into the system. Also, they've paid a rich dividend to the government of India. I think 2.7 lakh crores is a huge dividend by any standard. Even if you compare it with the larger economies of the world, they've not been able to give such high dividends to their own governments. So I think that will also give a push to the liquidity into the system. Trump's tariff have been a lot more confusing than one could really understand. especially the way Trump has been doing flip-flops on a regular basis. None of the governments across the world have been really able to understand what does he really want.
Thank you for having me here. Pleasure to share my views on the upcoming monetary policy as always. Let's get to the major thing. We do expect a 25 basis point cut in the repo rate because the inflation trajectory as of now, it looks quite promising, and we do believe it's going to undershoot the RBI target of 4%, not only for the time being, but also well into the financial year 2026. So 25 basis points cut for the upcoming monetary policy is a given. That is point number one. Point number two is, as regards GDP growth rate, we may see a slight downward revision because of so many global uncertainties. So we have to keep in mind that on a domestic front, we are well off. We do not have much imponderables or uncertainties. However, on the global front, we do have uncertainties. We all know that just 2 days before, when everything was going fine, the Trump administration suddenly imposed a 50% tariff on steel and aluminum products. Now, such kind of knee-jerk and sudden reactions are always problematic, because if we just take this particular instance, it is going to affect not only steel and aluminum directly, but all other derivative products which are dependent on steel and aluminum products. So such actions would have a negative impact on growth. And then we do not know what is in store. This is only one policy uncertainty. There could be several uncertainties which are in vogue. For instance, we still do not know the fine contours of the truce trade deal, which is in the offing between India and the US. So what I feel is growth will be towards the lower end of the economic survey estimate of 6.3 to 6.8%. So at least from the RBI side, it's likely that they would reduce the GDP growth by around 20 to 30 basis point for FY26. And regarding global factors, yes, as I mentioned earlier, it's going to be a volatile and uncertain scenario. And I would also like to add that on the liquidity front also, we may expect some changes, because on their part, it looks like there is going to be a conscious effort to move towards a new liquidity framework. What are the contours of that? At least some hint we are likely to see in the upcoming monetary policy. So if a repo rate is cut by 25 basis point, and if we go by the assumption that CPI inflation is towards a 3.5% target, and if we assume a terminal repo rate of 5.5%, we can be 5.25 also. But let's assume conservatively that the terminal repo rate is 5.5%. We can very well see the 10-year GSEC going towards 6% from the current 6.25% levels. So it means there is going to be a ripple effect on the corporate bond yields also. So you would have seen that the AAA and the AA corporate bond market, the corporate bond yields across the curve has fallen very drastically. So that is going to continue. And big corporates which are well rated, they would find borrowing from the corporate bonds much cheaper compared to taking a loan from the bank, because 1-year MCLR of bank is still much higher than the similar corporate bond yields. So to put it short, to digress into credit market and all, if you confine to the debt market, yes, the bond yields across the tenor is likely to soften further. Not just the GSEC, corporate bond yields are also going to see a fairly good amount of decline going forward.